Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 10th of May 2020. And yesterday we published our gold and silver weekly update for the week ending the 8th of May. And on Friday, an interesting video entitled, Does $10,000 Bitcoin Challenge Gold and Silver? And we've placed links to these two videos in the description box below. Now today we wish to talk about China. And this was really sparked off from the video we produced last Wednesday entitled Global Recovery May Start in Asia, Not America, where we quoted an article published in Reuters where the chairman of Standard Chartered Bank gave an interesting perspective of recovery by suggesting that it's likely to be driven in Asia and not in the United States or the West. Now, on the back of that, in Bloomberg today, we've seen an article under the headline of China pledges stronger monetary policies to handle growth hit. We shall read a few excerpts from it. Quote, "The People's Bank of China said the country faces unprecedented economic challenges and it will resort to more powerful policies to counter the hit to growth. Policymakers will pay more attention to economic growth and jobs among multiple targets," the central bank said in its quarterly monetary policy implementation report released on Sunday. It reiterated that prudent monetary policy will be more flexible and appropriate, and that it will maintain liquidity at a reasonably ample level. The phrase, "will avoid excess liquidity flooding the economy," was missing from the policy outlook section. It was in the previous report for the fourth quarter of 2019. Now, other highlights from the report includes 1. Will advance interest rate reform with regards to the loan prime rate and guide the lending rate lower. 2. The policy outlook section deleted the usual description of what tools the bank plans to use to direct bank loans to the real economy. Previously, it explicitly stated that it would use cuts to required reserve ratios and also to target RRR. 3. The People's Bank of China will keep China as one of the few major economies that's implementing normal monetary policy. 4. Will bring relending and rediscounting policies into full use and expand credit support to sectors such as agriculture and trade. 5. Will maintain basically stable prices as China's economic fundamentals suggest there's no reason for long-term inflation or deflation. 6. Will push banks to replenish capital through channels including perpetual bonds. 7. Will contain financial risks, make sure it's generally controlled. 8. Global economy has slipped into recession track in short term and the impact may exceed expectations. The international outlook for controlling the outbreak remains unclear and global policy room is limited. 9. Attention needed to the spillover effects of monetary easing in other major economies, including on China's balance of payments. And 10. According to the report, the interest rate for the standing lending facility was cut by 30 basis points on April 10th. Bloomberg reported last month that the rate would likely be lowered. Now, of course, whether China is able to achieve all of these goals and to how effective their implementation will be remains to be seen. In addition, as we covered last week, banks and governments have now begun turning inward with a view to only looking after themselves first as opposed to adopting a globalization approach, which was the previous standard. This means that other governments and banks will adopt their own measures to attempt to stay ahead of the curve. Reuters also published their take on this situation earlier today. We shall now quote a few excerpts from their article. Quote, "China's central bank said on Sunday it will step up counter-cyclical adjustments to support the economy and make monetary policy more flexible to fend off financial risks. The first quarter monetary policy implementation report from the People's Bank of China did not repeat the central bank's long-standing vow to refrain from flood-like stimulus to support growth, reinforcing signs of more policy measures. China's long-term stable economic trend remains unchanged. But at present, challenges faced by China's economic development are unprecedented. We must fully consider difficulties, risks, and uncertainties, it said. The bank said it will keep liquidity ample, using both aggregate and structural policy measures, and continue to deepen interest rate reforms to help lower borrowing costs and allocate financial resources more efficiently in the economy. The central bank will also support the real economy, especially small and medium-sized enterprises, it said. We should properly handle the relationship between stabilizing growth, ensuring employment, adjusting structure, preventing risks, and controlling inflation, the PBOC said. China's economy contracted 6.8% in the first quarter from a year earlier, shrinking for the first time since at least 1992, raising pressure on authorities to do more to stop mounting job losses. The PBOC has already rolled out a raft of easing steps since early February, including cuts in reserve requirements and lending rates and targeting lending support. The central bank will continue to deepen the reform of the loan prime rate regime and improve the monetary policy transmission mechanism to help lower borrowing costs, it said. In August 2019, the PBOC overhauled the benchmark lending rate mechanism by using the market-driven LPR to replace the previous benchmark bank lending rate. It will keep growth of M2 and social financing in line with and slightly higher than nominal GDP growth, it said. It will deepen foreign exchange market reform, maintain yuan flexibility, and keep the yuan basically stable, it said. China will also develop its financial markets to fuel growth and economic restructuring. The government will support fundraising by private firms through equity financing and bond sales, part of efforts to reduce the economy's excessive reliance on bank lending. Meanwhile, the PBOC said it would promote systemic opening of its bond market and will introduce more long-term investors. To protect investors, regulators will seek to unify disclosure rules for various types of credit bonds and improve the mechanism to deal with bond defaults. The PBOC also vowed to foster a resilient, competitive, and inclusive financial system and continue to improve corporate governance at major financial institutions, including commercial banks. End of Reuters article. In essence, China is basically saying what the Fed recently stated. They will do whatever is necessary to prevent the economy moving into recession or depression. The solution seems to be more spending, lowering of interest rates, and more money creation. It's also alluding to the agreement to purchasing less than A1 or AAA quality debt, something those of us in the West may decide to call junk bonds. The reference to the term, quote, "Meanwhile, PBOC said it would promote systemic opening of its bond market and will introduce more long-term investors," unquote, suggests to us the creation of longer-dated instruments or derivatives, thereby, they hope, enabling the kicking of the can down the proverbial road. This policy has its critics for sure, and especially those who believe in sound money. That said, such initiatives may just work, albeit for the short term. One day there will be a day of reckoning, but if all countries around the world adopt similar measures to some degree, they will to some extent counteract one another. And some of the smaller, less developed countries will undoubtedly fail. As far as China and the US is concerned, they are both likely to remain standing. The issue, of course, is, can they both survive long-term together, or does one have to fail for the other to reign supreme? Regardless of how it ends, there is no doubt that with China having to some degree what was once termed a command economy, with most of their major industries controlled centrally, they may be able to weather the storm with fewer casualties, well, at least again in the short term. The question we're asking here is, will China be the nation that helps drive the world out of recession, as it has for perhaps arguably the past 20 to 30 years? Or will it fall victim to its own excesses and the lead taken by someone else? Taking the medium-term perspective into view, whatever the answer to that question is, this level of money creation and credit creation will prove beneficial for precious metals, especially gold, and then following in its path, silver too. Do share your thoughts whether you agree or disagree, and thank you for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. And this evening we're updating the Richard and Greg channel with the announcement from the British Prime Minister Boris Johnson. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.